Global financial markets have been off to a rocky start in 2023, and there's a few key dates as of March 2023 that all investors need to be aware of. They're coming up in the next 2 to 3 weeks. This is going to have dramatic impacts on not only stock market, but on real estate, on crypto, and just the overall U.S. economy. So everyone needs to be aware of this information. What we're seeing is that Minneapolis Federal Reserve President Neel Kashkari, he came out on Tuesday, right around March 27th, March 28th, and he said that as of the beginning of March, the Federal Reserve and central bank has not made enough progress into combating inflation. He says there are a few key metrics that he's looked at that prove this. The first of which is that he says Labor Department reported that non-farm payrolls grew by 517,000 in January, which is nearly triple the Wall Street expectation and the strongest growth for the first month of the year since 1946. He says if the Federal Reserve had restrictive enough policies in place, we would not see this tremendous amount of job growth in January. He said we would see a lot lower number. We have seen record-breaking job growth, and it was triple the Wall Street expectation. So he says that is the first sign that shows they have not done enough. The second thing he says is that we've also seen that there are imbalances in the labor market between supply and demand. Right now, there are nearly 2 open jobs for every available worker, and average hourly earnings rose by 4.4% in January from a year ago. So that is simply unsustainable, and they need to get the target rate back down to 2%. He says that when we're seeing wages rise that much, when we're seeing this many open jobs available, that is not a restrictive economy, and we should be in more of a restrictive place right now in terms of labor, supply, and demand. So he says so far this is just showing us that the effect that they've put into place, it's a little there, but it's really muted, and we haven't seen it take full effect yet, or it just means that they haven't increased rates as high as they should have. So moving forward, he says he sees a likelihood that the Fed's benchmark borrowing rate should rise to 5.4% from its current target range of 4.5 to 4.75%. So that puts us about 75 basis points higher than where we are currently at. He believes, around 75 basis points more in rate hikes. I want to quickly interrupt today's video to bring you a word from our channel partner, Panda. Panda is a new messaging app that is fast, secure, easy to use, and has tons of cool features that make it perfect for anyone who wants to stay in touch with friends or family. Some of the best things about Panda, in my opinion, are that it is, first of all, secure. Its conversations are fully encrypted, meaning that you can be sure no one else is able to see what you're talking about. The second is speed. It is built on a state-of-the-art infrastructure, so you can send and receive messages even if you have a slow internet connection. And third is battery use. It's lightweight and doesn't use up a lot of your phone's resources, meaning that it won't drain your battery or slow down your device. Panda isn't just a messaging app. It also has a ton of features that make it perfect for group chats and staying connected with your friends. You can share photos, videos, you could use different emojis and share locations with a tap of a button. Here's the best part. Not only is it great for messaging and groups, but you can also earn money through Panda. And every time you refer a friend to the app, you also earn a small commission, and if your friends refer their friends, you'll earn even more. It's a great way to earn some extra cash just by using the app and sharing it with your friends. So if you're looking for a new messaging app and you're looking for a way to earn easy money on the side, definitely give Panda a try. It's available on App Store and on Google Play Store, and it's completely free to download. So use the link in the description and let me know your thoughts. The second person we've seen was from Atlanta Fed President, which is Raphael Bostic. He came out and had a little bit more of a positive noted response, which caused a little bit of a rally in the market immediately after his announcement. So according to Raphael Bostic, he says that quarter-point U.S. rate increases is best to limit risk to economy. He says that he is still very much in the mindset that slow and steady is going to be appropriate course of action. He thinks that the cumulative effect of all the rate hikes over the last year has not been seen yet. And he says that he thinks this is going to be starting to take effect on the economy in spring and a little bit later in the year. So he says going at a measured pace and increasing by 25 basis points reduces the likelihood that they overshoot, they damage the economy, and that they hurt things more for long term. So he has penciled in another half percentage point increase, so 50 basis points as what is needed, what he thinks is going to be needed, but it's all going to depend on upcoming data. And ultimately, Bostic had more of a measured, systematic, and not approach versus Minneapolis Fed President Neil Kashkari. Neil Kashkari saying, look, we have not done enough yet. We need to continue to raise interest rates. We have not seen any effects on the economy. Jobs are too high. And Bostic is saying, look, it's going to take a little bit more time for us to see the effects on the economy, but we shouldn't just go ahead and continue to have dramatic increases. He says we could, pause and have these smaller 25 basis point rate hikes, but no need for anything dramatic just yet. Last person is going to be the Federal Reserve Chairman Jerome Powell, because we have seen from a number of Fed presidents across the U.S., but Fed Chair Jerome Powell is going to be speaking at a committee on March 8th. He's going to be speaking and testifying at the House Financial Services Committee on March 8th, 2023 at 10 a.m. Eastern Time. And this is going to be about the U.S. Central Bank's semi-annual monetary policy report. Usually in these meetings, he doesn't go to address how they're going to combat inflation and what he thinks about specific measures the Fed will take to combat inflation. He usually tries to keep these for FOMC meetings, but just in this, we should also get a sense as to what he thinks the current state of the economy is. This is going to be the next major meeting from Jerome Powell, next major speaking event where we'll see him talk publicly, and it's something that you're going to need to keep an eye out on, because that's going to be a massive day for volatility in the market. So that's March 8th. The second day is going to be where CPI data comes out. CPI data is an obvious indicator of inflation, and the next report is set to be released on March 14th, 2023. So between March 8th and March 14th, we're going to see a lot of volatility in the market. We're going to be seeing Jerome Powell speak on March 8th, and then we're also going to see how inflation is holding up, how these policies are holding up on March 14th when we see CPI data released. If we see that inflation comes in well below 5.6%, which was what it was in our last CPI report, that would be great news. That would be great news. We'd see stocks and crypto rally dramatically. If we see the same 5.6% or higher, that would not be good. That would mean the Federal Reserve really needs to take harsher measures and put more dramatic policies in place to bring that interest rate, to bring that rate back down to around, what they're looking to have it at. So either way, keep an eye out on these two dates, March 8th, March 14th. We're expecting big moves and big things happening for financial markets on those two key dates. But let me know your thoughts. What do you think is going to happen? Do you think we're going to continue to see struggling market and have the Federal Reserve raise interest rates dramatically, or do you think they're going to continue with a more measured and a bit of a slower approach?